Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, my name is Kezia Pinaria with student number 170161955. I'm from the Bachelor of Economic Education 2019, and today I'm going to present my thesis with title Effectiveness of the Monetary Policy Transmission Mechanism for Asset Price Channels in Indonesia in 2016 to 2022. There is Professor Dr. Harya Kunchara Wiralaga, MSI, as my first supervisor, and Professor Dr. Ari Saptono, SEM, PD, as my second supervisor. First one is introduction. There are research background, problem formulation, and research purposes. So in 2020, Indonesia experienced a contraction in economic growth of minus 2.07% and deflation due to the COVID-19 pandemic. However, the government has issued fiscal and monetary policies to overcome this. The Indonesian economy is projected to grow positively in 2021 and 2022 at 3.70% and 5.31%. The number of investors in the capital market has increased significantly in the 2022 period. For stock investment itself, the highest level of IHSG of all time was reached in 2021 at level 6.435. This data is published by PD Custodian Central Effect Indonesia, KSEI. So, in the study, the researcher mainly focused on monetary policy. Monetary policy aims to maintain stability in the prices of goods and services, which are reflected through inflation. So, through this research, we can see the effectiveness of the policy by looking at how inflation responds to changes given by the related variables and how each transmission variable contributes to explaining the final target, namely the stabilization of prices of goods and services. In the study, it is described through the inflation rate. So the problem formulation and research purposes. First one is, how will inflation respond to changes in the monetary policy transmission variables of the asset price channel in Indonesia in 2016 to 2022? And the second one is, what is the contribution of each asset price channel monetary policy transmission variable in explaining the amount of inflation in Indonesia in 2016 to 2022? Literature review. There are supporting theories, relevant research, and theoretical framework and hypothesis development. Supporting theory. The first one is quantity theory of money from Irving Fisher in 1911. It said that this theory examines the interaction between the demand for and supply of money and their impact on the price level. Second one is natural rate hypothesis versus rational expectation hypothesis. So, the natural rate hypothesis states that there is a certain level of an unemployment that is considered a natural or long-term level in the economy. It's said by Milton Friedman and Edmund Phelps in 1960. And the rational expectation hypothesis states that economic actors are able to make predictions or expectations about economic variables based on available information rationally. And it's said by Robert Lucas in 1970. So the next one is Keynes' theory of money demand. There are transaction, speculation, and on guard. So in transaction, the need for money is driven by the necessity to conduct daily transactions. In speculation, the desire to speculate or invest in financial assets like shares, bonds, or property often motivates demands for money. And the last one is on guard. The money demand motive is due to the need to hold cash for emergencies or uncertainties in the future. It's said by John Maynard Keynes in 1936. The next theory is from William Baumol and James Tobin in 1952. The name of the theory is Baumol-Tobin theory. This theory describes how individuals decide whether to hold cash or invest in productive assets that generate income based on personal preferences. Next, it's from James Tobin in 1969. It's called Tobin's Q theory. Tobin Q theory explains how stock prices are affected by monetary policy, which will ultimately affect investment spending. The next one is inflation theory. It's called structuralist theory by various economists. So in this theory, inflation said that it emphasizes the rigidity or inflexibility of the economic structure of developing countries. Relevant research. The first relevant research is from Arvin Kurniawan and Rini Dwi Asturi in 2023 with the title Transmission Mechanism of Monetary Policy Through Asset Price and Exchange Rate Channel in Indonesia. So the study found that stock prices are more effective than bonds and exchange rates in achieving the ultimate target of economic growth. Next one is analysis of monetary policy transmission through asset prices and inflation expectations in Indonesia. It's made by Rifka Pratiwi Balkish and Ahmad Albert Tanjung in 2022. The results of this research show that the inflation expectations channel is more effective than the asset price channel in realizing the final inflation target. Next, it's from Muhammad Firmansyah in 2022 with the title Effectiveness of Monetary Policy Transmission Through Banking Credit Channels and Asset Prices in the Final Target of Inflation. The results showed that the variables BI7DRR, investment credit, working capital credit, IHSG, and DPK had a significant long-term effect on inflation. Next one is analysis of the effectiveness of monetary policy from a conventional and Sharia perspective on inflation in Indonesia in 2013 to 2020. It's made by Rindani Dwi Hapsari, Mega Rahma Kurnia Putri, and Nurul Huda in 2021. The results obtained show that SBI has a negative effect on inflation. Then it is also known that conventional monetary policy is faster in controlling the inflation rate than Sharia monetary policy. So the next one is theoretical framework and hypothesis development. So the first hypothesis in this research is inflation in Indonesia responds to changes in the monetary policy transmission variables of the asset price channel in Indonesia in 2016 to 2022. And the second hypothesis, each asset price channel monetary policy transmission variable contributes to explaining the amount of inflation in Indonesia in 2016 to 2022. Research methods. There are object and scope of research, data collection technique, variable operationalization, and analysis technique. Object and scope of research. The objects in this research are inflation and monetary policy transmission of asset price channels in Indonesia, which contains variables including BI7DRR, interest rate, PUAB interest rate, IHSG, and GDP. The scope of research is between 2016 to 2022. The data is monthly, collected monthly. Data collection technique. The data type in this research is secondary data. The data source is monthly statistical data from the Central Statistics Agency, BPS, and Indonesian Financial System Statistics, SKKI, published by Bank Indonesia from 2016 to 2022. Next one is variable operationalization. So the first variable is monetary policy transmission mechanism asset price channel. The definition is monetary policy transmission through the asset price channel is a transmission channel that influences the development of asset prices both physical and financial assets. The indicators are BI 7-day reverse separate interest rate, interbank money market interest rate or PUAP, composite stock price index IHSG, and gross domestic product. The scales are all ratio. The second variable is inflation. So inflation is a general and continuous increase in the prices of goods and services over a certain period. The indicators, so inflation is measured through the consumer price index or CPI. CPI is an index that measures the average changes that occur in the prices of goods and services consumed by households within a certain period of time. Changes in the CPI reflect the level of inflation, and the scale is ratio. Analysis technique. So the technique in this research are first, data stationary test. Second, optimal length test. Third one is VAR stability test. Fourth, co-integration test. The fifth one, VAR or VCM. Sixth one is impulse response function. And the last one is forecast error variance decomposition. Results and discussion. So in this section, there are description of research data and results. So the data used in this research is secondary data with time series data type starting from 2016 to 2022. It was taken from the Central Statistic Agency or BPS, Indonesian Financial System Statistics SKKI, published by Bank Indonesia, as well as from literature references such as papers, articles, journals, and other sources. In this research, there are 5 variables that will be analyzed using EV software, namely the BI 7-day reverse repo rate, the interbank money market, interest rate, the composite stock price index, the industrial monthly production index large and medium as a projection of gross domestic product and inflation. So the results for the first one, data stationary test. So for data stationary test is done by using augmented decoupleur or ADF at the same level until the data is stationary. In the stationary test, data is said to be stationary if the probability value obtained is smaller than the critical value of 5%. On the other hand, if the probability value obtained is greater than the critical value of 5%, then the data is said to be non-stationary. So the first one, I tried at making data stationary test at level, but it didn't work. So I changed it to the first difference and it worked. The data stationary test is stationary at first difference. Second one is optimal leg length test. The optimal leg length is marked with the row with the most asterisks, where the value with asterisks is the lowest value for each test iteration. Based on the results of the optimal leg length test, it was found that the optimal leg was leg 1 because there were 3 lowest values for the VPE, AIC, and HQ criteria. So with the optimal leg length test, we know that the optimal leg for this research is 1. So we made the VAR model with leg length 1. Third one is VAR stability test. A VAR model is said to be stable if the model's value is at a radius little is a radius smaller than 1. Based on the stability test of the VAR model that has been created, it is known that all the model's values obtained are at a radius smaller than 1, namely 0.519811, 0.286614, 0.182919, 0.1829119 and 0.012287. From these results, it can be concluded that the VAR model form is in a stable condition. Next one is the cointegration test. The cointegration test was carried out to determine whether there was a long-term relationship between the variables studied. To determine whether there is cointegration, you can see the star symbol in the Atmos section. Based on the results of the cointegration test, the results showed that the five variables were cointegrated with each other, where there is a star symbol in the Atmos section, and also added with a note at the bottom of the table that says trace test indicates five cointegrating equations at the 0.05 level. Next one is for our VCM. Due to the presence of cointegration in the variables, the model used is the factor error correction model. VCM is a technique in time series analysis that is used to model long-term relationships between variables that have cointegration. So this is the picture of the factor error correction model that I used for this research. So from the VECM, we can continue our analysis into impulse response function or IRF. So the impulse response function is used to find out how long it takes for each variable to respond to changes in the form of shocks given by other variables until it reaches stability. In this impulse response function analysis, the researcher will only focus on the response of inflation to other variables, where in the study, the researcher will look at the response up to the 30th period. So after looking at how inflation responds to changes of other variables, we can continue our analysis to forecast error variance decomposition or FEVD. This analysis is used to show the amount of information that each variable contributes to other variables in the VAR or VCM analysis. In the study, researcher focused mainly on how other variables contributes to define the inflation in Indonesia in 2016 to 2022. So in this part, closing part, there are conclusion, implications, research limitations, and recommendations for future research. So there are two conclusions that the researcher could make. The first one is in the impulse response function analysis, it is known that all variables, namely RBI7DRR, RPUAB, IHSG, IPB, IBS, and inflation itself provide different shocks to inflation. In this research, it is known that the variables that provide the longest shocks in influencing inflation are the inflation variable, RBI7DRR, RPUAB, IHSG, and then IPB, IBS as the projector of GDP. Second one is in the forecast error variance decomposition analysis, it is known that all variables, namely RBI7DRR, RPUAB, IHSG, IPB, IBS, and inflation itself, make different contributions to inflation. In this research, it is known that the variable that makes the biggest contribution is the inflation variable itself, followed by RBI7DRR, IPB, IBS, IHSG, and RPUAB. Implications theoretical. First, according to the results of this research, through impulse response function analysis, it is known that each asset price channel monetary policy transmission variable used in this research is capable of providing a shock that is responded to by the inflation variable with different shock periods. Also, According to the result of this research through forecast error variance decomposition or FEVD analysis, it is known that each asset price channel monetary policy transmission variable used in this research contributes to the inflation variable with different magnitudes. Implications for the practitioner. Results of this research are used as additional information for relevant institutions in determining policies related to the monetary policy transmission mechanism, so that this policy can be effective in achieving the final target, namely the stabilization of prices, which can be reflected in the level of inflation. Research limitations. Based on this research, there are several limitations experienced and can be factors that can be considered for further research in order to improve this research. Some limitations in this research include first, the research period used is 7 years, starting from 2016 to 2022, which is still relatively small to examine the effectiveness of the monetary policy transmission mechanism on asset price channels in the long term. The second one, the data used in this research is secondary data, and there may still be errors from researchers in entering data in the form of numbers. Recommendations for further research. First, further research is expected to use other variables to better demonstrate monetary policy transmission. Second one is it is hoped that the results of this research can be used as a reference for the government to pay more attention to the course of monetary policy transmission, especially in the asset price channel, so that the transmission can run more effectively in influencing the ultimate goal, namely a moderate inflation rate. So that's all that I can share with you all about my thesis. Thank you for watching.